A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
You hear that beep, that little chirp from the card reader at the coffee shop? To most people, that is the sound of a transaction finishing. But as of today, Monday, March 23rd, 2026, that beep is actually the sound of a starting gun. It is the beginning of a multi-day, multi-billion-dollar journey through what we call the Cascade.
It really is corn. My name is Herman Poppleberry, and I have spent the last week submerged in the plumbing of global finance. What looks like a sub-second interaction to the person buying a latte is actually a tiny geopolitical and legal event. It is a moment where technology, law, and massive corporate interests collide.
Today's prompt comes from Daniel, who wants us to look at the process of what happens when we use a credit card. Specifically, we are digging into clearinghouses, the broader financial system insights we can glean from this, and why moving money between accounts is still so much more complex than most people expect here in the spring of 2026.
It is the perfect time to talk about it because the friction in this system is reaching a literal boiling point. Just 5 days ago, on March 18th, the Merchants Payments Coalition reported that swipe fees hit a record $198.25 billion in 2025. That is a 5.9% increase from the previous year. We are talking about a 2% tax on almost every digital interaction in the modern economy.
That is an astronomical amount of money just for the privilege of moving digital bits around. It feels like a massive, invisible tax on the entire world.
It functions exactly like a tax. The average swipe fee for Visa and MasterCard credit cards rose to 2.36% early this year, up from 2.35% in 2024. But to understand why it costs that much, we have to pull back the curtain on what happens after that little beep. Most people think the money moves instantly because the screen says approved.
Right, because when I see approved, I assume the merchant has the money and I have the debt. But that is just the first stage of the cascade, isn't it?
That is just the authorization. Think of authorization as a digital pinky promise. When you tap your card, the merchant's bank, which we call the acquirer, sends a message through the network, usually Visa or MasterCard, to your bank, the issuer. They check if you have the credit limit and if the transaction looks like fraud. If everything is green, they send back a message saying approved and put a hold on those funds. That takes about 2 seconds.
But no actual money has changed hands yet.
None at all. The merchant just has a promise. The real heavy lifting happens in the second and third phases, clearing and settlement. This is where the clearinghouses come in, and this is where the complexity really lives. This is the part of the cascade that takes days and involves some of the most powerful institutions on Earth.
So, let's define that for the listeners. What is a clearinghouse actually doing? Is it just a giant database that keeps track of who owes what?
It is a database, yes, but more importantly, it is a legal guarantor. In the world of finance, we use a term called novation. This is the process where a clearinghouse essentially steps into the middle of a transaction. They become the buyer to every seller and the seller to every buyer. By doing this, they guarantee the trade. If one bank fails to deliver the funds during those few days of processing, the clearinghouse steps in to ensure the other side still gets paid.
That sounds like a massive amount of risk for the clearinghouse to take on. Why would they do that?
Because they are the ones who own the system. The clearinghouse, or TCH, is a private consortium owned by the world's largest banks, like JP Morgan Chase and Citi. It is led by CEO David Watson. They operate the plumbing like the automated clearinghouse system and the newer real-time payments network, or RTP. They take on the risk because it allows them to control the rails that the entire economy runs on.
You mentioned clearing and settlement. Walk me through the difference there, because I think people often conflate the two.
That is a key distinction. Clearing is the process of transmitting, reconciling, and confirming payment orders. It is the data phase. This is where the clearinghouse calculates the net obligations. Imagine Bank A owes Bank B $10 million from 5,000 small coffee purchases, but Bank B owes Bank A $8 million from different purchases. The clearinghouse nets those out.
So instead of moving $18 million back and forth, they just move $2 million from Bank A to Bank B.
That is netting. It drastically reduces the amount of actual liquidity needed in the system. But the settlement is the final step. That is the actual discharge of the obligation. That is when the legal ownership of the funds actually transfers from one institution's account at the Federal Reserve to another's. This is what we discussed back in episode 1025 when we talked about the 3-day money gap.
And that is why it takes days. We are still living in a world of batch processing, even in 2026.
We are transitioning, but legacy systems die hard. For decades, the system has relied on sending these huge files of transactions in batches at the end of the day. It is like the difference between sending an instant message and sending a physical bag of mail once every 24 hours.
But wait, we have the internet. We have fiber optics. Why are we still sending bags of digital mail?
Part of it is technical debt. These banks are running on core systems that are sometimes 40 or 50 years old. But the other part is the need for finality. Finality is a legal construct. It is the point at which a payment cannot be reversed. In the traditional system, that window is kept open for things like fraud checks and dispute resolution. If the money moved instantly and irrevocably, banks would have no way to pull it back if they realized a minute later that the transaction was fraudulent.
So the delay is actually a feature, not a bug for the banks.
It was a feature for a long time because it allowed them to manage liquidity and catch errors. But in a world where everything else is instant, that delay is becoming a massive economic drag. That is why we are seeing this huge push toward real-time rails.
You are talking about RTP and FedNow. I saw that FedNow just hit a milestone of 1,500 participating institutions earlier this month, on March 2nd.
They did, but there is a fascinating battle happening there. Even though FedNow is the public sector option from the Federal Reserve, the private sector RTP network, run by the clearinghouse, still handles about 98% of the instant payment volume in the United States. RTP processed over $1.3 trillion in 2025 alone.
Why is the private sector winning so decisively there? Usually, when the Fed steps in with a public utility, it gains more ground.
It comes down to the existing relationships. The big banks already own the clearinghouse. They built RTP to keep control of the rails. FedNow is great for smaller community banks that might not want to be beholden to the big guys, but the sheer volume is still on the private side. However, FedNow is growing fast. Its total value reached over $853 billion recently, which is a 460% increase year over year. The gap is closing, but the big banks are fighting to keep their dominance.
Okay, so we have these two competing sets of high-speed rails. Does that mean my coffee swipe is going to start settling instantly?
For credit cards, it is more complicated because of the debt aspect. When you use a credit card, the bank is lending you money for those few seconds or weeks. That adds a layer of risk that a simple bank-to-bank transfer doesn't have. But the messaging standard is changing. We are moving to something called ISO 20022.
I have heard that term tossed around in tech circles. It sounds like a very boring name for something very important.
It is the global language for financial messaging. Before this, different systems used different formats, which meant data would get lost or misinterpreted when money crossed borders. ISO 20022 allows for much richer data to be attached to every payment. It is not just person A sent $20 to person B. It can include invoices, tax information, and specific purpose codes.
So it makes the clearing phase much smarter.
Much smarter and much more automatable. This leads us to one of the most interesting developments of 2026, which is agentic commerce.
Ah, the AI agents. We did a whole episode on this, episode 920, about giving AI the credit card.
And it is becoming a real headache for clearinghouses. When a human swipes a card, there is a certain pattern of behavior. When an AI agent is authorized to make autonomous payments on your behalf, say your smart home agent buying groceries or your personal assistant booking a flight, it creates a massive challenge for fraud detection.
Because the intent is harder to verify. If my bot buys $1,000 worth of cloud computing credits while I am asleep, is that a legitimate transaction or a hack?
The clearinghouses are having to rewrite their risk models in real time. They are looking for ways to verify the handshake between the user's intent and the agent's action. If they can't verify it quickly, they have to revert to the old, slow settlement methods to protect themselves. This is the tension. We have this incredibly fast Ferrari of a payment system, but we are still using a paper map and a nervous driver.
And that tension is what is driving the political fight over swipe fees. You mentioned the $198 billion in fees. That is why Senators Dick Durbin and Roger Marshall tried to attach the Credit Card Competition Act as an amendment to that housing bill on March 13th.
And it failed again. The banks and the networks have an incredibly strong lobby. They argue that if you force them to offer non-Visa or MasterCard routing options, it will compromise security and kill rewards programs. But the merchants argue that the lack of competition is why the fees keep climbing while the actual cost of processing a digital signal is dropping toward zero.
It is wild that Visa and MasterCard still control 83% of the volume. In any other industry, that level of concentration would be under constant antitrust fire.
It is under fire. Look at what is happening in the United Kingdom. On March 17th, just last week, the Court of Appeal in London granted Visa and MasterCard the right to appeal a ruling that their interchange fees violated competition laws. This legal battle has been going on for nearly 20 years. It shows how much these companies are willing to spend to protect the toll booth they have built on the global economy.
And then you have Rohit Chopra at the CFPB here in the States. He has been a vocal critic of what he calls junk fees.
Chopra is looking at this from the consumer side. He is concerned that the complexity of the clearinghouse system hides fees that eventually get passed down to the person buying the coffee. If the merchant has to pay 2.36%, they just raise the price of the latte by 10 cents. The consumer pays for the invisible cascade whether they realize it or not.
So why is it so complex? If I can send a high-definition video across the planet in milliseconds, why can't I move $5 from my bank to the coffee shop's bank just as fast?
Because money isn't just data, money is a legal claim. When you move money, you aren't just moving a file, you are moving a liability. If I send you a video and it gets corrupted, we just send it again. If I send you $5 and it gets lost in the ether, someone is out $5 and the entire trust in the financial system takes a hit.
So the complexity is the cost of trust.
It is. The clearinghouse provides a centralized point of trust. They manage the collateral, they manage the haircuts on that collateral, and they ensure that even if a major bank goes under tomorrow morning, the payments you made today will still settle. That requires a massive legal and technical infrastructure that has to work perfectly every single time.
But surely there is a more efficient way than this layered middleman of the middleman approach.
There is, and that is what the shift to real-time rails is trying to achieve. By moving to a system where clearing and settlement happen simultaneously, you remove the need for that multi-day netting process. You move from, I promised to pay you on Friday to, I am paying you right now.
If we get to that point, does the clearinghouse even need to exist?
It changes its role. It moves from being a netter of delayed obligations to being a real-time orchestrator. It still has to handle the ISO 20022 messaging, it still has to handle the fraud detection, and it still has to act as the legal guarantor of finality. But the float, the money that banks make by holding onto your funds for 3 days, disappears.
And that is why they are fighting it so hard. The float is incredibly profitable.
It is a massive hidden revenue stream. When interest rates are high, holding billions of dollars for even 48 hours generates significant interest. That is the 3-day money gap we talked about in episode 1025. The system is designed to be slow because slowness is profitable for the intermediaries.
This really brings us to the broader insight into the financial system. It is not just a neutral utility. It is a contested territory where every millisecond of delay is a battleground for profit.
That is the most important takeaway. When you look at the cascade, you are looking at the power dynamics of the global economy. The fact that the Senate couldn't even get a vote on the Credit Card Competition Act amendment on March 13th shows you who currently holds the high ground.
So, where do we go from here? If you're a business owner, or even just a savvy consumer, what should you be watching for?
You need to watch the adoption rates of the real-time rails. If RTP and FedNow continue their exponential growth, we are going to see a point where merchants start offering discounts for direct payments that bypass the credit card networks entirely. Imagine a world where the coffee shop says, tapping your card is $5, but using our real-time app is $4.90.
That 10-cent difference is the swipe fee they are saving.
And that is where the real competition will finally come from. Not from a new law in the Senate, but from a technological bypass of the traditional Cascade. We are already seeing this in places like Brazil with Pix or India with UPI. The United States is just late to the party because our legacy system was good enough for so long.
It feels like we are in this weird middle ground where the technology is ready, but the legal and political structures are still catching up.
We are in the Great Transition. The shift from batch processing to real-time rails is probably the most significant structural change in finance this decade. It is going to change everything from how you get paid. Imagine getting your salary by the minute instead of every 2 weeks, to how companies manage their supply chains.
The idea of getting paid by the minute sounds like a nightmare for my personal accounting, but I can see how it would help people living paycheck to paycheck.
It removes the need for payday loans and high-interest short-term credit. If the money moves as fast as the work is done, the entire concept of liquidity changes. But that requires the clearinghouses to be fully automated and the legal definition of finality to be updated for the digital age.
I think the AI agent piece is what really fascinates me. If we're moving toward a world where most of our transactions are being handled by bots, the speed of the rails becomes even more critical. A bot doesn't want to wait 3 days for a settlement. A bot can perform 10,000 transactions in the time it takes you to sip your coffee.
And that is the pressure point. The agentic commerce model simply cannot function on a 3-day settlement cycle. It would create a massive backlog of unsettled liabilities that would break the risk models of every major bank. So, the bots might actually be the ones who finally force the banks to modernize.
It is a move fast or break the bank situation.
Quite literally. The clearinghouses have to evolve or they will become bottlenecks that the new AI economy simply routes around. We are already seeing merchant groups like NACS and Walmart fighting the proposed $30 billion settlement that would cap interchange fees at 1.25%. They argue it is not enough. They want a total overhaul.
Well, I think we have thoroughly deconstructed the coffee swipe. It is definitely not as simple as a beep and a green light. It is a journey through legal novation, ISO messaging, political lobbying, and real-time rail competition.
Not at all. It is a journey through the very heart of how power and value are distributed in 2026.
Before we wrap up, let's hit some practical takeaways. First, the shift to real-time rails is the structural change of the decade. If you are in business, you need to be looking at how your systems can integrate with RTP or FedNow.
Second, remember that finality is a legal construct, not just a software state. Just because the screen says it is done doesn't mean the money has legally changed hands. That gap is where the risk lives.
And third, keep an eye on the CFPB and Rohit Chopra. Their stance on junk fees and interchange regulation is going to be the leading indicator of how much pressure the government is willing to put on the Visa-MasterCard duopoly.
It is a fascinating time to be watching the plumbing corn. Most people only care about the sink, but the pipes are where the real action is.
Spoken like a true nerd, Herman. I love it.
Guilty as charged.
Alright, I think that is a wrap on the Cascade. Will AI agents force a total rewrite of clearinghouse protocols? Only time will tell, but the swipe is dying, even if the Cascade is getting more complex.
It is the end of an era and the beginning of something much faster and much more automated.
Thanks to our producer, Hilbert Flumingtop, for keeping the show running smoothly behind the scenes.
And a big thanks to Madal for providing the GPU credits that power this show. We couldn't do these deep dives without them.
This has been My Weird Prompts. If you want to keep up with us and get notified when new episodes drop, search for My Weird Prompts on Telegram. We would love to see you there.
We will see you in the next one.
Oh, goodbye.
Goodbye.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, my weird prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My weird prompts, that's the flows from sloth, from man, from long-eared host. My weird prompts, until next time, stay curious, keep weirding.